The following analysis of Era Group is part of the Birkenroad Reports program at Tulane University's A.B. Freeman School of Business. My name is Adam Bubis, and my fellow analysts are Luan Vo, Daniela Sosa Diaz, and Artemis Ma. Our presentation will begin with a company overview. Next, we will move into the industry analysis, followed by an explanation of our investment thesis and valuation. Then we will go over risk associated with the company, and lastly, we will talk about additional ways to view this stock's potential performance. Era Group trades on the New York Stock Exchange under the ticker symbol ERA. Currently, Era is trading at a price at $11.71 per share. Our target price for the stock is $12 per share, so we give Era a market perform rating. Era is a Houston-based company engaged in providing helicopter transportation and leasing services within and out of the oil and gas industry. It conducts operations primarily in the U.S. Gulf Coast and Alaska. But it also conducts operations in Norway, the UK, Spain, India, and Brazil. Era's primary service is transporting customers to and from offshore oil and gas rigs, making up approximately 75% of Era's operating revenue. Era also offers search and rescue services, air medical services, and utility services. Additionally, Era conducts dry leasing activities supported by its two joint ventures, Dart Holding Company and Era Trading Center. Era's fleet of 160 helicopters consists of 9 heavy helicopters, 62 medium helicopters, and 89 light helicopters. Era operates within the energy, equipment, and services industry and mainly provides services to the upstream oil and gas industry, which consists largely of oil and gas exploration, development, and production companies. The projected outlook for the energy, equipment, and service industry is bleak for the coming year due to the drop in crude oil prices. The S&P Oil and Gas Equipment and Services Index decreased 11.5% in 2014 and has decreased 9% as of July 2015. The helicopter service industry presents high barriers of entry due to the strict entry requirements such as initial large capital investments in high-tech equipment, resource ownership, high operating costs, certifications, and safety regulations. 3 major industry drivers that impact helicopter service providers in the oil and gas industry include offshore rig count, the supply of helicopters in the industry, and the price of oil and gas. When the U.S. offshore rig count increases, the number of personnel needing transportation increases. However, in the last year, the offshore rig count decreased roughly 50%. Adversely impacting Era, whose flight hours and revenue were down around 20% in the second quarter of 2015. Currently, there exists a surplus of helicopters in the industry. This oversupply lowers demand and decreases the value of helicopters. Lastly, over the last year, oil and gas prices dropped drastically, causing oil and gas companies to decrease capital expenditure, cut down on production, and cease exploration activities, all of which reduced demand for helicopter services. Era recently went public when it completed a spin-off from Seeker Holdings on January 31, 2013. Since going public, Era has been defined as an emerging growth company. This means the company is eligible to take advantage of certain exemptions from various reporting requirements. Due to new technology and the attractiveness of drilling in deeper water, companies are drilling farther out in the ocean. This is a positive trend for Era, since when oil companies move further offshore, there is an exponential increase in the demand for helicopters. Since longer flights take more fuel, typically less personnel can be on a given helicopter. That leads to more trips. Unfortunately, in the current macroeconomic condition, oil and gas companies are not exploring any new drilling opportunities. Operating revenues and profit levels fluctuate due to seasonality. The second and third quarters tend to generate more favorable working conditions and higher demand for Aera's services. On June 25, 2015, Aera opened its 35-acre superbase in Houma, Louisiana. This superbase will facilitate around 15,000 passengers per month traveling to and from the U.S. Gulf of Mexico. The opening of this base signals commitment to the Gulf Coast region. In April 2015, Aera acquired 75% interest in Hauser Investments Limited, which has 100% ownership in Citra Helicopters. In May 2015, Aera sold FBL LLC to Piedmont Hawthorne Aviation for $14.3 million in cash. We used the price over book value and price over EBITDA multiples to determine our 12-month target price of $12. This estimate is a bit conservative relative to the markets. Now we're going to talk about 3 common tools used to evaluate companies: the Altman Z-score, the Peter Lynch earnings multiple chart, and the Ben Graham model. The Altman Z-score analyzes a company's risk of bankruptcy. Aera has a low Z-score of 0.73, indicating a high probability of bankruptcy. However, we do not believe the Altman Z-score is a good indicator of bankruptcy for Aera. The ratios used in calculating the Z-score rely on total assets as a denominator, and Aera must have a large amount of assets to generate revenue. The Peter Lynch chart helps investors see if a stock is overpriced or underpriced relative to the earnings line, which is the price 15 times the earnings per share. On November 12, 2015, Aera was trading at $11.40, 15.2 times earnings. Last year at this time, the stock was trading at 32 times earnings. Peter Lynch would likely consider buying the stock. The Ben Graham model examines a series of 8 hurdles to evaluate a company. To qualify as an attractive investment option for Ben Graham, a stock must satisfy at least 4 out of the 8 qualifiers. Aera passes 6 of the 8 hurdles in the Ben Graham analysis. Therefore, this analysis puts Aera at the higher level of attractiveness to Ben. Aera's business is susceptible to many industry and company risks, which can be broken into 3 categories: operational risk, regulatory risk, and financial risk. I will briefly mention some risks which stand out. Aera has heavy reliance on offshore oil and gas. As I mentioned previously in the video, 75% of Aera's operating revenue stems from companies operating in the offshore oil and gas industry. Aera is also dependent on few large customers with flexible contracts. In fact, Indarco, BSEE, Shell, and Williams account for 48% of Aera's revenue. Since Aera is a U.S. company and operates mostly in the U.S., the U.S. Department of Transportation and Federal Aviation Administration requires that 75% of Aera's outstanding voting stock be held by U.S. citizens. On behalf of my team of analysts, thank you for watching.